for the next several months, there's nothing right now to tell you we're heading into a global bust. I have reasons why I think it's going to morph into that later. But for a few months, you can have your cake and eat it too. At the very top, everybody's going to be all in. The narrative is going to be the Fed engineered a soft landing.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. David Hunter, Chief Macro-Strategist, joins us today. David is an investment professional with some 50 years of investment experience combined with a contrarian philosophy. And we're delighted to have David join us once again today. It's time to saddle up and silver up for David Hunter. David, welcome back to SBTV. How are you doing?
Hi, Patrick. Good to see you. It's been a while.
Yes, good to see you again. Also, it has been a while, and I apologize for that. We got to get you on more often. So, David, I want to start off with the stock markets. The Dow futures are right around the highest they have been this year, 2024. David, question here is how is it that the market just seems to keep on chugging along no matter what the news, how much the correction or pullback, how is it that seemingly we can always expect a bounce back at a time where there is so much uncertainty, whether political, geopolitical, warfare, or even welfare going on?
Well, as you know, markets like to climb a wall of worry, as they say. So there's plenty of skepticism out there, and that's a good thing. That's future fuel for the market. And my view is we're in the 42nd year of a secular bull market that started in August of 1982. I think we're in the final stages of that. But I think the last stage is going to be the steepest, most dramatic stage. So we just came through a 2-month consolidation. Your market corrected from mid-July, had the big sell-off on August 5th when we had the yen carry trade reversal, and it has spent the last 10 days or 2 weeks retesting, basically a partial retest, not all the way back down. We've come out of that and turned back up. I think we're about to start what I call the parabolic leg of the secular bull market. So I think I've been talking about a melt up for several years. We had a melt up in 2020 and 21 when the market was up over 100%. Then we had the bear market in 2022. And since October 22, we've been in this new bull leg. I think it's going to steepen as we move to the top. I think the top could happen this year and probably will happen this year. There's no magic to the calendar end. If it carries into the first quarter, so be it. But I actually think the likelihood is that we see the top this year. My targets for the indexes are S&P 7,000, NASDAQ 24,000, Dow 55,000, and the Russell 3,300. So I'm talking 30 to, I haven't done numbers lately, but 30 to 40% upside with the Russell, maybe 50% upside from here. And to say that can all happen between now and the end of the year is crazy, I know, but that's what I mean by a parabolic final blow off. And the point of it is people want me to pinpoint when, and I don't know exactly when it's going to end, but it's going to be that kind of a steep run into the end, whether it takes 3 months or takes 5 months. Nobody can know that for sure, but I would bet we see, if not all of it, most of it this year.
So all of these markets are expecting a parabolic move, as you phrase it. Why parabolic? What are you seeing or analyzing that causes you to say parabolic moves?
Yeah, so part of the thesis is that a market will steepen into its final top. So the legs just get steeper as you move, and we've had pretty steep runs. We were up. I don't know what the number was for the Nasdaq from 10,100 to 18,000 plus in the last 2 years or less than 2 years. And this last leg's just going to be even steeper than that. So it's the nature of how markets kind of come to a finality. And because this is a 42-year bull market, 42-year secular bull market, there have been cyclical bull markets within that and bears, but it's a 42-year secular bull market. We don't see those often. Obviously, that's a long run. And so I think the last piece of it is going to be the most dramatic. And besides that, what you've seen this last couple of years is a lot of skepticism and lack of belief in this market. So from October 2022 all the way up, at least until we got to, let's use the S&P, from 3,500 at the bottom and on October 13th, 2022, it ran and people kept saying all the way up, this thing's going to roll over and go to new lows. They believed that all the way up, that it was just a bear market relief rally and it was going to roll back over and go lower. They believed that all the way up until probably 4,300, maybe a little higher. And then they started saying, maybe we're wrong. Maybe this thing has legs. But so they thought maybe it can go back to 45,600. From there, it pulled back to 4,100. And they were sure that was the rollover again. It wasn't. And obviously from 4,100, we were off to the races to new highs. Once we got to new highs, particularly once we got over 5,000, you had more people jump on the bullish bandwagon. All the way up, they were really not believing it was a new bull market. They thought it was a bear market rally. So we've gotten up to 5,600 and change, and then pulled back for a couple months. Now we're about to go new highs. And I think as they see it to new highs, along with a Federal Reserve that is about to start a new easing cycle, I think the combination is going to get this thing going. So both technically, it's going to be free sailing. And secondly, I think people are underestimating how important it is that after 2.5 years of Fed tightening, we are about to start a new easing cycle. Easing cycles don't come around often. And when they do, they usually do signal something. And I know there's a chart that's been going around for a couple of years that when the Fed starts cutting rates, it's time to head for the hills. That signals the end of the bull market. That's not typically not true. It's not always true. What that chart is signifying is that when you are going into a really rough downturn, and the Fed finally recognizes it, that means you're just beginning to start the rough part of the downturn, and you better sell your stocks. This time around, right now, we have a soft landing look to the economy. There's nothing there to say we're heading into a 2008 or 9, or that this is one of those rough downturns. Right now, the narrative on the street, and I think the continuing narrative will be for the next few months, soft landing. That the Fed engineered this well. They got inflation all the way back down to their target, or just about to their target, and they didn't have to have a recession to get there. So now they're seeing the signs that if they go any further, they're going to have a recession. So they're turning the other way. When you have that go on, where you're just flattening out, you're not heading a lot lower in the economy, then you react to a Fed cut or to an easing cycle in a very positive way. Now, I have to tell you, I'm looking for a global bust next year. So I'm not saying that's my forecast of where the economy is going, but I'm saying that's the Wall Street forecast, and that's the Fed's forecast of where things are going. So for the next several months, there's nothing right now to tell you we're heading into a global bust. I have reasons why I think it's going to morph into that later. But for a few months, you can have your cake and eat it too, where you can have the wind at your back from Fed easing, earnings expectations moving up for next year, and people still not bullish. So they have to commit money because they've been defensive. So I think that's what the next few months means. And I think you're going to see it build on itself, so that you'll get FOMO, you'll get a lot of that bearishness is going to turn into bullishness. And as I say, at the very top, everybody's going to be all in. The narrative is going to be, We engineered us. The Fed engineered a soft landing. We have a big cycle ahead of us of ever higher earnings for the next couple of years at least, and clear sailing. That isn't necessarily going to be the case, but as you know, at the top you're most bullish, and that's what we'll see.
If you're enjoying this interview with David Hunter and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, there are 6 different types of accounts to fit your needs? To find out more, go to www.silverbullion.com.sg, click on the signups tab, and choose from one of these 6 types of accounts. Or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. David, you gave me a lot to unpack here. I mean, there's so many things going on in my mind, but I think I'll first start with you mentioned bear market rally, or is it a bull market? Um, where are we between these two things, or perhaps even a few more? But what would be perhaps one or two concerns with this seemingly very bullish market right now? What things do you think would be on the horizon that we might see to have us reassess our investments despite this bullish market?
First and foremost, we are most definitely in a bull market. The question is, yeah, as you know, once we got hit hard in early August, the story out there became, oh, we made a double top, and or after the basically we went to 5650 and went down to 5200 or whereabouts, went back up to 5600. So people thought that was a double top in August, early September. And if we're going to push to new highs here as we are, then that takes away that double top, and it may take a little while, but I think people are going to be within the next week or two jumping on that bandwagon saying, wow, this thing has a lot of legs. As to things to worry about, obviously I can be wrong, but I can't stress enough. There is so much skepticism out there. We're at all-time highs, and you got everybody worrying about what's coming on the downside, right? Including you, it sounds like. So everybody's assuming this thing's close to the end. And what I keep saying is, time-wise, we may be only a few months from the end, 3 or 4 months from the end. But if I'm right about my targets, and they're high conviction targets, we're talking about 2 and 3 years worth of returns still ahead of us. That's what makes this such an unusual period. Is if I'm talking 30, 40, 50% returns, that normally is something you get over, if you get 10% a year, that's 30%. If you get more than that, that's a huge year. And especially when inflation is down under 3%. And yet I'm saying you could get that in the next 4 months. So, it's pretty phenomenal what I'm describing here. It's a combination of a blow off top, which means people get irrational, and the fact that they underestimated how much was still left in this in terms of earnings, in terms of the resilience of the economy, et cetera. So, I'm not focused on what can go wrong, because I think everybody's already focused there. It's what you should be focused on is what can go right.
Moving to the S&P, it's been on a winning streak of sorts lately, as we are seeing both Treasury yields and the USD dropping a bit ahead of the expected Fed rate cut. I think they're looking at 25 to 50 basis points or so. Speculation is the softening of the dollar will push the Japanese yen, as you just mentioned, the carry trade issue that went on not that long ago. But David, do you see the same with the yen despite coming off the recent carry trade meltdown?
I actually have had, well before the carry trade issue, I've had a forecast out there that the yen would finally bottom out, and that we would see a 0.0085 yen to dollar. So everybody else does the dollar to the yen, but yen to the dollar, 0.0085. It gotten way down there. So I'm not surprised by this rally, and everything I look at in the charts says it's going a lot higher. So, however, I don't think it's going to lead to another shoe dropping in terms of the yen carry trade. I think you had all those that had to get out because costs were rising fast and they were leveraged, or they had borrowed and they couldn't carry that. Um, that happened that day. Obviously, you had the panic selling, but then you had a period where the yen pulled back some and the market rallied. So I think the balance of those that had to get out because of the carry trade or wanted to reverse the carry trade, a lot of that's already happened. It happened more gradually after August 5th. So I'm not worried about that, at least not now. Um, I think that's kind of in the rearview mirror at this point.
And so when we get to this melt up, where do you where do you see the markets going? And I think more importantly, what actions do you expect the Fed to do once we reach that melt up and things start to reverse somewhat?
Yeah, it's interesting. For a couple of years, I had said, and it was very clear to see, um, that Powell had bought hook, line, and sinker into Bill Dudley's thesis about the importance of getting the market down to tighten financial conditions. This is going back to 2022. Obviously, that was April 2022. But for the next year, it was a real concern that, gee, if the market's going up, we're not tightening. We're not tightening enough. We need to get that market down. And I criticized Powell a lot during that period and said, your job should not be trying to decide where the market should be. Bill Dudley's wrong. The market, in its infinite wisdom, will go where it goes. Your job should be focused on the economy and inflation. And so he had his head handed to him several times in 2022, particularly the latter part of 2022, when the market went up, when he was calling for it to go down. Every time they had a Fed meeting, and then thereafter, if the market rallied on his comments, he'd have his minions come out and talk it down, right? You could see there'd be one after another would talk about, trying to get people bearish again. And, it was foolishness, a waste of energy. He finally abandoned that, probably in first half of 2023. And he hasn't shown any interest in trying to call the market since then. So I don't, there is a possibility if we get this market up on stilts, like I'm calling for, that might come back. He might say, hey, we got animal spirits out here going crazy, speculation's going crazy. We have to tighten back up. That's possible, particularly if that leads to a bounce in the economy or bounce in inflation. You could see him come back the other way. And that would fit into my global bust thing, that they would be zigging when they should be zagging or what have you. They'd be tightening on the eve of what is already a very dire situation. I don't know if he's going to do that or not. What I do know is they're not focused on money. They're focused on rates. They're keeping the balance sheet. They're still shrinking the balance sheet. They're still letting roll off happen and not replacing it. So you are seeing some tightening on the money side. At the same time, they're about to start cutting rates. I think it's becoming less. They are, the last several months, they haven't been letting as much roll off or haven't been shrinking the balance sheet as much. But money still matters. And there is a point at which they're not realizing that even if rates are coming down, if they're not boosting the balance sheet, they're not easing. So there is a point there. But for the next several months, you're going to have the wind at the back in terms of rates are coming down, Fed easing. The bond market, and I've said this for a long time, the bond market leads the Fed in terms of rates. So when everybody was focused on, is the Fed going to ease? Is it going to be a quarter or a half? I go, it doesn't matter if 10-year rates have already dropped over 100 basis points, and now they've already dropped 100 and 35, 40 basis points. So you've already had the easing, much more easing there than you're going to get out of the Fed. And I'm calling for a 2.5% 10-year this year. So we're at whatever 365 now. So I'm calling for it to go to 2.5. So a little over another 100 basis points down between now and the end of the year. And then next year in the global, what I call global deflationary bust, I think you could get the 10-year down to zero. So, but that's during the opposite of what we're getting now. You're going to have a huge financial crisis and economic downturn next year, not this year. And I don't know exactly when it starts, but then the Fed will have to get a lot more aggressive than they will here. But just focused on this year, I think you will see 50 basis points next week. And I think you'll see at least two more 50s between now and the end of the year. That's my guess. But I'm pretty sure they'll cut in November, and again, unless they get turned off by the market being so high, you probably get another one in December.
Yeah, you think those 50 basis point consecutive cuts? I guess as you're speaking, you think that might kind of rock the markets a bit here? I mean, because I don't know, but in your 50 years of experience in the markets, have you ever seen all of this Fed speak and Fed influence really move the markets the way it does?
Oh, sure. I can talk to August of 1982. That's why that market took off. We had a Fed that was finally recognizing they had to go the other way. They had created a double dip recession in the 1980 to 82 period, trying to wind down inflation that was very high. And it was August of 82 when they basically started going the other way. No doubt the Fed can have big influence. It certainly had an influence in 2009. So, that chart that's gone around that has everybody thinking when the Fed starts eating, you go the other way. That's just it's going to be one of the most misleading pieces of information that we've ever had out in the marketplace. People are bearish because of that chart. I've been asked that question at least 1,000 times. Don't you think when the Fed starts cutting rates, that's a bearish signal? No, it depends on where you're at in terms of the overall markets, where you're at in terms of psyche, et cetera, where you're at in terms of the economy. So no, I know that thesis is out there that it's going to be a quarter because if they did a half, the market will panic. That's nonsense. He's going to come out, I'm pretty sure, in the press conference afterwards and explain it very easily. We are 200 basis points behind the market. We're at 5.5%, and the 10 years at 3.60, and the 2 years even below that. So we're almost 200 basis points behind the market, maybe more. We can't be doing a quarter. We got to do a little more than that. They're not going to do more than 50, but I think there's enough evidence that inflation has gone the right way. Even today's import prices, those were tremendously down. So you're seeing across the board that everybody was shook up by the CPI. The CPI was pretty much in line. There was a 0.1% increase in the monthly. Big deal. I mean, we are seeing that we are, there are other inflation, trueflation measures inflation outside the Fed and outside of the popular measures. They have inflation down below 2% already. We know the housing is overstating inflation in housing. It's a laggard. So there are a lot of signs that we're pretty close to their target already, and still heading down. So I just don't think all he has to do is say, this is a move to get our policy more in line with where it should be relative to where inflation is, relative to where the market, bond market is. We're not doing this because we see something awful out there. In fact, the opposite. We see a soft landing. If he says that, the market's not going to panic.
Yeah, soft landing. I mean, I know it's kind of circling around where it's a word we haven't heard in a while, and how well is the Fed engineering the soft landing? But I think another question tying into these things are, you know, how did the Fed or other central banks get so far behind the curve?
Yeah, I know they were slow because they are always late. I mean, they basically are looking at laggard numbers, laggard data. But I think they don't forget we had a pandemic,
Yes.
and they argued for a good long time, and it's been proven somewhat right now that a lot of that was supply side that it was transitory. And it was only when, it really was when Russia invaded Ukraine and oil went to 130 bucks a barrel that they panicked and they said, "Oh my God, we got to tighten." And they started, I think, at a quarter, but within a month they were having their head handed to them. So then they did three-quarter point increases, 3/4 of a point, 3 times in a row in their meetings. That's a huge jump, and it's because they did. There was a lot of criticism out there, and they were behind the curve. But now they're behind the curve in the opposite direction, and this is also typical. Is that they're looking at backward-looking data. They're looking at jobs, which is a lagging indicator and doesn't show up until later. And then their other mandate is inflation. Obviously, it was sticky for a while. So they are so afraid after what they did in 2022 of being late to fight inflation. They were so afraid to ease for fear of inflation breaking back out and getting criticized again. And it's caused them to stay the party on the tight side, in my opinion, too long. So that's why I think there's a global bust next year. But you're not going to know that for a while, because right now, if you judge the Fed on what they've done and what you can see in front of you, they've done it just right. We have a soft landing right now, and we have inflation down at their target or pretty close right now. So based on current, everybody told them they should have eased earlier and they waited and all that. They may, and I do believe they will be found to have waited too long, but they didn't listen to those that said ease earlier, and it looks like they did it right. They didn't listen to those that said you got to tighten more, and it looks like they did it right. So right now, he looks like he's gotten the porridge just right. The that may not be the case. I believe they've over tightened. I believe we'll find out. We have, and not only they, but other central banks, that they were fighting the last war when they should have been understanding how things are starting to deflate. But that's a 2025 story. That's not a story for today.
Okay, David. So with all that you're saying, this melt up and I guess obviously a meltdown, the way the markets are going, and you reforecasted your gold and silver targets. Where are you with precious metals?
Yeah, I raised my silver target from 60 to 75 back in my July letter. So that's pretty recent. And I've increased my target for gold as of this week. I just increased it a couple days ago before the breakout, from 3,000 to 3,400. So I think we are just starting. Yesterday was a big day. Today's an okay day. I think silver and gold are just starting what I think are going to be huge moves. You could see both of those targets reached in the first quarter, is my guess. So I think you're going to see stocks and bonds and metals all move together. And I know people have been frustrated by the miners. I think the miners are going to have a huge catch up rally here in the next 6 months.
Okay, yeah, because gold seems to have been doing pretty well. Obviously, it's been hitting multiple all time highs. Even though the stock market has been going up, gold has been going up with it. But yet, silver. Do you have any opinion on why silver seems to be lagging so much?
Silver's been very frustrating for investors and miners even more. But um, it's amazing because we had a peak of 48 on silver in 2011, and we're just crossing the 30 level now, and it was down in the low 20s. But you got to remember, we were 22, 6 months ago, and we're now 30, and we crossed 30 a few months ago, and then backtracked and filled in, and we're crossing 30 again. I think you'll get back up to the highs here in the next few months, probably pretty quickly. It just, for whatever reason, and people are skeptical and think it's been manipulated, etc. For whatever reason, it has been a very frustrating trade. But I do think that's behind you. People need to start understanding that the bear market's behind us, and it's going to be a pretty amazing bull market ahead, I think. Now, in the global bust next year, I think both gold and silver will be hit hard. Silver harder because it's more cyclical, but you could have, silver if silver goes to 75, certainly could, give back 50 to 75% of that in a bust. Gold, if it goes to 3,400, could come back to here, certainly, and maybe below here. So it's not a straight line. Again, my big call beyond the bust, because they're going to be printing money like crazy to pull us out of the bust. By the end of the decade, I see gold going to 20,000 and silver going to 500. So, but as I said, it's not a straight line. You got to worry about next year. If we have a global bust, there's going to be a big correction. So it's not a buy and hold idea where people can do whatever they want. But I think they'll be disappointed if they buy here, let it have the big gains, and then lose them in the bust. So just kind of cautionary tale there. Probably the other thing I would say is I've been a bear on oil. I was probably the only real bear on oil, and I've been calling for $60 for quite some time. I mean, really from 130 last year or back in 2022, I called 85, and then when it got down there, I said we're going to 60 over time. It wasn't going to be quick. We're almost there now. I mean, we've got down to the mid 60s and have bounced. I think the odds are we're going to see 60 this year, and maybe even below 60. Could see 55 or below. But in the bust, I think oil could go down to 30. So that's something people have to keep in mind, is that oil is not going to trade with the markets. I don't think it's going to be one of the counter moves. And then post bust, I think we're going to have a huge commodity boom, which will include energy. And I think oil could get to $500 a barrel by late this decade, early next.
David Hunter, before we wrap up, can you tell the good people how they may follow you and see more of your work?
I'm sure. I'm on Twitter every day, so my handle is at Dave H. Contrarian. You can find me replying to people there every day. I also put out a quarterly investment letter, macro letter, that if they haven't, it's by subscription, so there's a cost to it. If they have interest in it, just direct message me, and I will give you details.
All right, David Hunter, I'd like to thank you for your time, and I really hope we can do this again soon. This took too long to happen again, but thank you kindly for coming on board once again.
Thanks, Patrick.
That was David Hunter sharing his views on precious metals and the economy. To see more of David's views and work, please follow him on Twitter at Dave H. Contrarian. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.